Welcome to the Money Rules Podcast, where we tackle your personal financial matters with leading financial advisors. Your host, Boitumelo Ntsoko.
Today we're discussing a major decision many aspiring entrepreneurs face: franchising versus starting your own business. Which is the smarter move for building real wealth and leaving a legacy? Because, let's be honest, not all businesses are created equal. Some just replace your salary. Others, if built strategically, can become true wealth-building machines, giving you financial freedom, flexibility, and transforming your family's future. So, how do you know which path is right for you? Gareth Collier, a certified financial planner at Firecrest Group, joins us on this episode to help us figure this out. Welcome to the show, Gareth.
Thank you, Tumi. Always good to be here.
Gareth, let's start with the big picture. From a wealth-building perspective, how do franchising and starting your own business compare when it comes to creating assets that can be passed down through generations?
Well, I think the first thing you've got to look at is from a franchising model perspective, these can be relatively straightforward to creating a transferable asset. A reason being that typically there's a lot of brand recognition, there's something in place, operational framework and systems are generally there, and it can make it really easy for, say, the next generation to actually step in and just continue with that business. But a lot of the time, we've always got to be cognizant of the fact that the franchise agreement is always going to be is going to talk to that in terms of how transferable that's going to be from a generational side. Whereas on the other side, if you look at your startups, starting your own business gives you the potential to build something that's sort of truly unique and very much yours. With your own brand, your own intellectual property. And this, when done intentionally, can possibly lead to a more substantial sort of legacy and greater control over that future. Although, in saying that, it does take a lot of effort in the beginning to build such a business from the ground up and even make it a viable or attractive asset for those future generations.
In your experience, where do most entrepreneurs go wrong with thinking about their business as long-term wealth vehicles, not just short-term income generators?
Yeah, I think that's such a key point. A lot of the time when you're on that entrepreneurial journey, particularly when you're starting out, the heavy upfront focus is going to go into generating that immediate income and cash flow just to keep yourself in business, and sometimes we don't strategically position ourselves from day one for building that lasting wealth. So just being in that sort of day-to-day, putting out the fires, making sure you can keep a roof over your head. Sometimes it can lack a little bit of strategic sort of long-term planning. Depending on your cash flow needs, it's that push and pull between kind of needing to survive day-to-day versus needing to reinvest in the business to grow. And possibly sometimes what happens is that owners within their business, be that a franchise or a startup, can maybe become so involved and the business becomes so reliant on them that they don't build something that becomes like a transferable asset, rather something that's just an extension of their own abilities.
Now, Gareth, franchises come with a blueprint and brand power. From a financial point of view, does this lower the risk enough to make franchising a safer route to building wealth?
I don't think it explicitly does. Obviously, having that established blueprint, having that brand power, it certainly mitigates a lot of some of the initial risks associated with starting your business and marketing that business, building awareness around that business. So like we kind of said to you earlier, you quite likely to benefit from those proven systems, training that goes in that brand recognition, which can maybe help you cover that distance from starting to profitability a little bit quicker. But it's also, franchising isn't exactly risk-free. As much as there's proven blueprints and systems in place, your particular franchise, its success is going to depend on your specific management, things like your local market conditions. And then obviously you're also subject a little bit to the overall performance of the franchise as a whole. So, that safety can come with a bit of a trade-off, because obviously from a cash flow side, there's some ongoing fees and maybe a little bit less autonomy around how to handle your particular business within the franchise model.
And on the flip side, can the ongoing fees, royalties, and lack of ownership control limit a franchise's wealth potential?
Yes, I think you certainly have to take that into consideration. Those fees, the likes of royalties and franchise fees, definitely will eat into your personal profit margins, which can maybe limit the speed at which you can accumulate that wealth that you're looking for. Like I said earlier, being within that franchise model means that you are a little bit limited in terms of how much autonomy and control that you've got around your decisions. So if you need to innovate, or maybe you need to be a bit more adaptable to your local market conditions, that can be a little bit more restrictive. And then, of course, you as the franchisee, the person that's engaged with the franchisor, you obviously subject to their overall brand and performance, which again is something that you don't have a lot of control over.
Gareth, when you start your own business, you control everything, the brand, the margins, and the future. But the risk is higher. From a generational wealth lens, does owning your own IP and brand give you a bigger long-term upside?
Well, yes, you would have to think that, owning your own intellectual property is going to allow you to kind of bring your unique skills, expertise, experiences, and take on things. Either you're going to be in a situation where a larger business identifies that and they see a lot of value in that and they want to maybe acquire that. Or it's going to be, it's going to build a nice moat around your business, which may give it a lot more longevity, which then can be a lot more appealing for that intergenerational wealth. So because you have control over being able to build that and create its direction, that can result in a much, much bigger sort of wealth situation down the road. And obviously it just comes from the fact that you are generally starting with less of a runway. You've got to do a lot of the groundwork. You've got to put down a lot of the foundations, a lot of the roots yourself to build this thing up from the ground. But the long-term payoff can be significantly more depending on the type of business you're involved in.
And what are some key mistakes people make when trying to build generational wealth through a startup, especially first-time entrepreneurs?
Yeah, I think for a lot of people, who are entrepreneurial minded, they're not explicitly sort of first and foremost finance people. You often have an idea or sort of this burning thing that you can imagine that you want to put out there. And, a lot of the time, if you're finance focused, you might look at all the risks and the potential downsides and you kind of stop yourself before you even start. But things like, a lot of people have the initial idea, but maybe long term they lack a little bit of that long-term vision and strategy for what they want this thing to ultimately become. And start with a smaller idea, and you've got to do like a little bit of a proof of concept. But then, how do you take that from being an idea that can generate cash into something which becomes a business which can be sustainable and have that longevity? So things like lacking that strategy. Other things like maybe not even having enough capital to start in the beginning, depending on the type of business there is, being, unable to adapt to your market conditions. Maybe you're a little bit too stuck on your idea and you possibly lack a bit of flexibility around what it could involve. And sometimes people have a wonderful idea that's incredibly unique and so new to the market and the world, but you don't realize this and you're so excited to put out there, you don't go and protect your intellectual property, and therefore somebody else could come along and copy it and really just almost sideline you entirely because they've got the scale and the means to do this thing too quickly. And then I think lastly, it's possibly starting without the end in mind. So a lot of the time, if we're starting something and we're wanting to just get it off the ground and we want to get that cash flow going, we don't stop to sit down and think about, okay, well, where does this end point look like for me? When should I reasonably step aside as the entrepreneur and let somebody else or the next generation carry this thing forward? So those are all kind of a bit of a checklist that you can have. It doesn't mean that it all needs to be done on day one, but certainly those are the conversations that we often will have with people once they are a little bit further along in the entrepreneurial journey.
Let's get into the numbers now. Is buying into a franchise or building your own brand generally more expensive? And how should someone budget realistically for long-term success?
Yeah, look, I think the initial costs can vary quite a bit. A franchise will often have significant upfront franchise fees, plus maybe the costs of setting up the business according to that franchise specification. Whereas a startup initial costs can be a little bit more variable depending on the nature of the business, possibly allow you to bootstrap it a little bit with sweat capital as opposed to finances. But when you look at budgeting for that longer term success, I think in either model, it's crucial to really look beyond that initial investment. So being diligent about sitting down, realistically coming up with a forecast of things like your ongoing operating expenses, your marketing costs, potential expansions, and really importantly, like if you have funds, how you're going to allocate those funds for reinvestment back into your business. Having that sort of emergency fund or contingency fund is really essential to weather sort of unexpected challenges. If you think about if you were an entrepreneur, say in 2018, 2019, none of us could have anticipated the lockdowns of 2020, and it might be a case of your business is great and it's the success is definitely there. It's just a case of having the financial means to give yourself enough legs to get through situations like that.
And regarding profitability and break-even timelines, which tends to pay off faster?
I think it would be reasonable to say that, if you choose well, then the franchise option would naturally have a faster pathway to that profitability and that break-even point compared to a startup. And I think, again, that's just largely due to the fact that there's an existing brand, there's established operating systems, and even potentially, like a built-in customer base. If you're going to launch a franchise of a well-known, let's say, a fast food business or something, you're probably going to get feet through the door pretty quickly. Whereas if you're on your startup, you usually require a lot more time in the beginning and effort to build that, that sort of customer or clientele that you may attract. And then also even within the business, it does take some time to sort of fine tune your operations to understand where it is that you should be allocating your resources and how do you get to that break even and profitability point.
And when it's time to exit or hand down the business, which model tends to have a higher resale value?
Look, I think, when you've got a well-established independent business and it's got its own really strong brand, maybe there's some valuable intellectual property there, you've got solid financials and a track record, you probably have the higher resale value compared to a franchise. And also maybe because the buying pool for like an independent business is possibly a little bit broader than a specific franchise. And then also I think the resale value of a franchise is probably quite heavily influenced by the strength of that franchisor. What does that brand look like? Have things improved? Have they gone a little bit worse since you started? What are the terms of the franchise agreement? But then again, inherently that franchise might always still have some underlying value because of those larger elements such as the brand and things. Whereas, if you're in a startup that's maybe not going as well as what you expect, obviously then the pendulum swings quite severely the other way where there might not be a lot of value in that resale.
If you're thinking about what your children will inherit, is it easier to transfer ownership of a franchise or your own business?
So I think transferring ownership of your own business to your children is generally going to offer you a bit more flexibility. You've got a lot more control over that process, and you can structure it sort of according to your own personal estate planning needs, what your children's needs are. Things like if you've got several children, you might only have one or two of them that are even interested in the business. So how does that reflect on your estate planning setup? And then, whereas with a franchise, transfer of that ownership is often subject to the franchisor's approval. So you may have all the intentions and it's a well-run franchise, but you are still governed by that franchisor approving the fact that your children might be in a position to take over from yourself.
For someone serious about building real lasting wealth through a business, what 3 key factors should they consider when deciding between a franchise and a startup?
I think firstly, they need to look at their own risk tolerance as well as their desire for control. So, whereas a startup involves higher initial risk, but also offers that complete control element, whereas the franchise would have, say, possibly a lower initial risk, but obviously a lot less autonomy. The second point is that probably should consider the long-term growth potential as well as that equity stake. So a successful startup can really yield significantly higher equity value, whereas a franchise growth might be a little bit more predictable, but potentially a little bit more limited, depending on the nature of that business. Thirdly, I think they need to assess their personal expertise and really, where does their passion lie? So do you have a unique vision of what you would like to build? Or are you maybe wanting to have your own business, but you're actually more comfortable operating within a proven framework, or maybe even a sector of the market that you are particularly interested and passionate about, and it would make sense to join a franchise model where you've got that larger brand, you've got those operating systems, you've got other people, possibly mentors and things within that system that you could turn to.
Gareth, before we wrap up, I want to touch on strategic moves, especially for those thinking beyond personal wealth to leaving a true legacy. If someone's goal is to grow personal wealth first, but then step into an investor or multi-business owner role, would you recommend starting with a franchise or their own business?
I think this turns back to the individual person in terms of their risk tolerance and your long-term strategy. So when you're starting out, that franchise can definitely offer that more predictable income stream, and that operational system with the lower risk, but, which can allow you to help kind of accumulate some personal wealth and maybe free up capital for future investments sooner. But on the other hand, when you're building a successful startup, that can lead to sort of significant capital gains if that person eventually sells that business, or it gives them the flexibility and autonomy to maybe install other people to run that business and use the profitability of that to expand into other market sectors that they may be interested in. But again, that startup model is typically going to take a lot more intense effort up front and probably carries that higher initial risk.
And how important is scalability when considering building a business that can eventually fund other investments or even future generations?
Yeah, I mean, scalability is crucial when you're building a business where your intention is to fund future investments or future generations. Without that scalability model, you very much become the business. And when you are no longer directly involved in the business, or maybe you've retired or you've passed away, is that business going to struggle to continue, or maybe it loses a bit of its identity? So where a scalable business model really allows for that significant revenue and profit growth without sort of that linear increase in operating costs. So what you want to find is that your return on every rand that you redeploy within the business is exponentially multiplying in terms of your profitability and your revenue. This then allows you to generate that surplus cash that you need for that reinvestment, either to that business or maybe expanding that business, or possibly just diversification into other assets that you might be interested in or see an opportunity in, or through your network have an opportunity to be involved in. And then, of course, where businesses are set up to be scalable and potentially you are looking to make that sale, that scalability is going to be a lot more attractive to other investors who are possibly wanting to get involved in the business or possibly buy out your business, which is going to allow you to really justify much higher valuations if you do decide to sell down the line.
Gareth, what role does debt play early on, and how should entrepreneurs manage financing if they're thinking about building multi-generational wealth, not just short-term gains?
Yeah, debt is one of those typical sort of double-edged swords, and again, particularly for early stage businesses. If you think about it from a business perspective, it can offer you the financing and the leverage that you need initially to grow and maybe to acquire some assets. But it's a fine line where you could be in a situation where excessive debts can really hinder your long-term wealth building, by draining a lot of the cash flow, because now you over leveraged, you're suffering under sort of interest payments, which is then kind of really stalling the next phase of that growth. So, if your focus is maybe doing this multi-generational wealth building, reasonably, I think a more conservative approach to financing is probably a bit more advisable, particularly starting out, where you prioritize those sustainable debt levels and, you have the cash where you can reinvest the profits rather than sort of heavily relying on borrowing. And then, if you understand that your intention is that multi-generational wealth, part of it is accepting the fact that what you build will unlikely be the final end product. And if it's something that you are going to pass down, you may have to accept the fact that you yourself don't receive the full 100% benefits of that business. You may receive a portion of that, but your intention is for the next generation and the generations after that to have an ever-increasing sort of benefit from that business. So those would be some of the key points to consider when you are structuring your business and what the intention is. What is it that you want out of it? What is it that you would find valuable and maybe one day allow you to step away or even pass on and sort of rest in peace, knowing that this entity, the sort of legacy that you've created has been handed down and will continue to generate and impact people's lives the way that you envisioned for it up front.
Gareth, how should entrepreneurs think about reinvesting profits, whether it's buying new locations, diversifying into real estate or other assets?
Yeah, look, I mean, that sort of strategic reallocation can be crucial for long-term growth, but not just growth, also a bit of diversification. So helping you protect what you've already built, allowing you to maybe ride some of the ebbs and flows of market conditions or possibly just sort of other conditions outside of your control, the likes of what we mentioned earlier with the likes of a COVID. If your business is heavily reliant on people being physically mobile and that all of a sudden gets shut down without your expectation, how are you going to survive through that? And I think a lot of the time people will often unintentionally make the mistake of expecting to make a large exit, so whether that's a sale or a handing down of a business or something one day, and that is going to provide them the capital that they need to maybe live in sort of this state of financial freedom or retirement, and they kind of don't focus on their personal planning. Because when you're an entrepreneur, you tend to blur the lines between you and your business. You kind of think of them as one and the same. So knowing how to sort of reinvest in your own life and your own financial sustainability and success, then you are less tied into what you can exit the business for one day, which then obviously changes the conversation about how that business gets handed down.
Just lastly, are there any warning signs that a franchise or a business idea might actually drain wealth instead of building it?
Yeah, I think certain things to think about. So whether something's maybe a fad, it's just popped up out of nowhere and it's become incredibly popular. Is this something that is a sustainable business idea, or is it something that is going to burn bright but not for very long? And do you want to avoid trying to jump in on that, throw a bunch of cash at it, and then 3-4 years down the road, there's no business there anymore? And with some franchises as well, we've got to look at what do those franchises do? Are those business models going to be around in 20 or 30 years from now? Is there going to be a need for the offering, the product, the service, whatever it may be that they provide? And then obviously look at within the franchise itself. You've got to look at things like, I think about the example of sort of something fishy from the early 2000s, where one negative carte blanche expose, kind of led to the unraveling of that whole business. And it had nothing to do explicitly with each and every franchisee, but they all suffered that same fate. So be aware, be cautious, do your homework, and also get to know sort of the people that you're going to be involved with.
And that brings us to the end of this episode. Thank you so much for joining us and sharing these valuable insights with us, Gareth.
It's always great to be with you. Thank you, Tumi.
That was Gareth Collier, a certified financial planner at Firecrest Group.
Thanks for listening to this episode of the Money Rules Podcast. To listen to more, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates. Moneyweb, your trusted source for business and investment insights.